Capital budgeting, chapter 10, decision methods. So here we're going to look at, we're getting closer to analyzing and valuing companies which you can utilize in your real life if you ever want to purchase a small business, or maybe you work for a large business and you're going to purchase or acquire a bigger business. So the idea is, say that someone in your family, or maybe you at some point in your life, say, I want to run a small business. Maybe I want to have a small clothing store, a shoe store, a pizza shop, bagel shop, laundromat, sell liquors and spirits, or wines and spirits. How does that go? The spirit, wine and spirits. Spirits sounds classier than liquor. Sell a store that just sells wine in a box, all the different varieties of wine in the box. Can I saw vitamin water in a can last at the supermarket, and I said that just doesn't feel right. In an aluminum can. So this can help you, give you different methods to value companies. So say I had some consulting work about 5 years ago. I don't do much of it anymore, but there was a point where I was helping people evaluate buying small businesses, and I did a bunch of delis, laundromats, a couple of pizza shops, and you always want to go with cash flow. And with these businesses, I'll use some of these businesses as examples here. And one big business wasn't huge, but it was like a chain of record stores, different things that the consulting work I made into like little problems for the class, so you can get some real world type of problems to see how you would value these opportunities and see as whether or not it makes sense. So for example, say for example, you want to buy your own Subway franchise. And there was a student once that during one of the harder economic times, he wasn't able to get a job. So he had said that his dad was going to fund him to get a Subway restaurant, and what I thought about that. And I said to him, I said, listen, I think that'd be a great experience, you know. And he was like, well, I was hoping for something more prestigious and start a job at a company, and I just kind of feel like a loser running a Subway. And I said, no, don't feel that way, because everybody I know who is wealthy or very wealthy, they don't work for somebody else or for a company. They own their own business. And try it. At least it will give you some experiences that you could use if you had to work somewhere else at a later date. So then a number of years ago, I was, and this guy's Subway was in Wisconsin, and I went to that Subway. I didn't realize it was his Subway, and I bumped into him, and I'm like, oh, how you doing? And he's like, oh, I'm doing so good. I have 3 franchises now, and I run 2 card stores, and I'm doing really well, and, you know, I want to, thank you for pushing me in this direction. I like the freedom of it and being in charge, and he says he's doing very well. It turns out he still charged me for the sandwich. So, but I thought at least he could have gave me a, half off or free bag of chips. But no, I'm just kidding. No, he did charge me, but that was all right. It's a businessman, you got to make your money. So, but the valuation methods we learned in this class, he used when he was trying to figure out whether or not to buy the Subway. Because it was already an existing location, and he was trying to figure out if the sale price, and using these methods, he was able to get the price down because he showed that the multiples of the cash flow didn't justify the price they were asking for the business. And generally for, say for a food location like Subway, I would probably value the business at 3 to 5 years of cash flow. For a laundromat, 2 to 4 years of cash flow. I mean, different businesses have different demands. So if you had a cash flow, the basic thing is, say you had a cash flow, a business generates $30,000 a year in profits. So if it was a Subway making $30,000 a year, that would be $150,000 after 5 years of cash flow is what you would pay for it. It would be a fair price. And you'd be surprised. A lot of times the Subways, they don't really make a huge amount of money. That's why you need to own a few of them. So they may, a good location, maybe you can make 100,000. A poor location, 10 to 40,000. So it's not as much money as you think, but these people generally, that's why there's so many Subways, because they keep opening. You needed 3 or 4 of them. And the basic failing of the business is that it's just lunch. Most people don't get it for breakfast or dinner. College students are the exception. You would probably have had Subway for dinner I mean, I was fine with that until I found out they put the rubber in the bread. Did you hear that? Health hazard. They put this chemical, it's like rubber polymer in the bread, and it's not healthy. They've taken steps to remove it, though. You could look it up. You could look it up online. Yeah, that's just what happened, though. It's local news. You have a PC. Check it out. Rubber in the bread, or a polymer, or some kind of plastic artificial to make it. So anyway, that would be a concern if I was buying a Subway. Is there any fallout from people who may not go there because of that? Because the motto is eat fresh and not eat rubber. So, okay, so we're going to talk about the capital budgeting process. People who listen to this that are not in the class, say internet people, they must be wondering, like, what is this guy class all? This is a weird class. We're going to talk about payback period. Everybody likes a good little payback every once in a while, right? No? Yeah, sometimes you just need a little payback. The net present value, internal rate of return, and the modified internal rate of return are 4 different methods that we're going to learn to calculate the value of projects. And we're going to talk about capital rationing and measuring the risk in capital budgeting and how to deal with it. So risk can be a factor. Clearly, and certain businesses are more riskier than other businesses. There's a reason why every time you're driving down the main road and you see nails, pizza, Chinese food, with stationery, and you drive, you know, or maybe those stores always make money. That's why you see, you know, you go to a shopping center and you'll see a bagel store, maybe a deli, pizza shop, Chinese food, right? Go down Middle Country Road and just count the pizza places and Chinese food places. Every plaza has one. Because they are low risk. They make money. Even a bad pizza place makes money. I don't know. I guess sometimes it's just not worth to drive an extra half a block for the better pizza place. But even Domino's makes money. And that is, I guess in this area, Domino's isn't so great because we have the best pizza in the country. But in other, I guess other spots of the world, other country may just say Domino's is a lot better than my local. I went to Florida and this is how they made the pizza. They obviously didn't know how to make pizza. It was bread, cheese, and sauce on top of the bread. They put it through one of those those ovens you see at Costco, though. It wasn't. They just did not. I guess you could make it that way, but I don't think that was the issue here. I think they just didn't know how to. And the sauce was ketchup. It wasn't tomato sauce. Okay, so let's talk about the process. We want to evaluate investment projects. So capital budgeting is the budget is you have, when we say capital, we mean money. So the company has X amount of money, and that's their capital. And they have to budget it properly to invest in the best investments they can choose. So they may have an option to buy 20 different businesses. They can only afford to buy 4 of them. They want to make sure that they get the best 4 possible. So managers are going to be tasked, financial managers will be tasked to rank, to analyze and rank the projects from best to worst and look at desirability based on how, not just the money the business makes, but how it correlates to the core competencies of the original company. So if you're McDonald's, you're probably better off buying another fast food franchise rather than buying a tire franchise. You know, you want something that makes sense and has aligned with the company as well as something that's profitable. And if they're mutually exclusive, that means that you're going to do one or the other, not both. So some projects are either, I think there's a slide on this later, independent or mutually exclusive. So if you can take as many independent projects as you want, but some projects may be mutually exclusive, meaning that you have one piece of land and there's only you can only really put one business there. So there could be a couple of different choices of businesses to start, but they're all mutually exclusive because you're just putting one on that piece of land, you know. Or it may be you are deciding whether to make a bridge or a tunnel, but you're not going to make both. So the mutually exclusive, you have to decide which would be a better project. Making a tunnel from, say, here to New York City, or making another bridge. Okay, so the four methods we're going to work with are the payback period, where it's the simplest method. We're going to discuss that in a minute. Net present value, where we're going to actually utilize our time value of money skills into determining the present value of a project. Internal rate of return, we're going to look at the actual percentage return of a project. And the modified rate, which reflects the fact that we will modify the rate at which new money is reinvested. Okay, so let's look at two projects, Project A and Project B. And you can see that we have the time frame is from year 0 to year 4, so 5 years. And in the first year, each project is going to require a $10,000 investment. And then Project A has a continuous cash flow of $3,500 year 1 through 4, and Project B has a cash flow of $500, $500, $4,000, $600, $10,000. So two different types of cash flows. Okay, so let's see. Okay. All right. So let's calculate the payback for Project A. And the payback is basically a time scale. We're trying to see how long before we pay ourselves back. So if you bought a business for $100,000 and you make $10,000 a year from that business, it'll take 10 years to pay back your initial investment. You know? So it'd be better if you spend $100,000 on a business that has $20,000 a year of cash flow, because now it's only going to take you 5 years to pay yourself back. And better yet, a $100,000 business where you make $100,000 the first year in cash flow. You pay yourself back in 1 year. So clearly you would want that business, that you pay yourself back sooner. It's less riskier, and you start moving into a more profitable area quicker. So it's, you know, common sense. Okay, so here we see in this Project A, we have the $10,000 that we invested in year 0, and as we make our cash flow, we start subtracting the cash flow we made from the investment until we get to, say, year 3. It's completely paid back, and we even have a surplus. So it takes us 2 full years, 1, 2, and then 90% of year 3. Okay. So let's move on to Project B. So if we're going to look at Project B, we have the $10,000, and you can see that it's slow going in the beginning, but by year 4, we're completely paid off. So it took us 3 full years and part of year 4 to pay ourselves off. All right. So it's a pretty simple decision rule. If the payback period is with under your limit, so you may set it as a limit of a company, don't accept any projects that take more than 5 years to pay ourselves back, then it's acceptable. So if you determine that it requires payback in 3 years or less, you would have to accept Project A and reject Project B. Here are some problems with this, though. What if Project B is going to continually return $10,000 a year every year after that year 4, and Project A is going to shrink down to $500 a year? You know, there's no, you don't, you know, Project A could be selling DVDs, and Project B could be selling Blu-rays. So one's going to ramp up and one's going to decline. This payback period doesn't tell you that. It doesn't tell you the future prospects of the business being successful moving forward. It's only looking at how quickly you pay yourself back. So if you invest in a business that's sort of shrinking, that's something you should really consider. And it also doesn't take into account time value of money. The sooner you get the money, and the more valuable it is than the later points. So it's not looking at either of those functionalities. So that's why this is a little flawed. But if you were looking at, it might be appropriate if you're looking at, say, 3 different pizza restaurants, and you want to know the payback period for the 3 different restaurants, and then if they were equal, same business and of equal future potential, then it might be a little bit more valid to look at this payback decision period. Okay, so let's move on to net present value. Here, we want to measure all of the costs and benefits associated with the project. And we're going to value the incremental cash flows, but we're going to discount them at a discount rate, basically applying the present value to all the future cash flows to put them into today's terms. So what we want to know is, if we're going to spend $1 million to buy this business, how much cash in today's value, making it equal. So we have the money we pay today is the present value of that money because we're paying it right now. But if we take all the future cash flows that we're expecting and discount it back to today, is it equal to or greater than the money we're putting into the business? Because if you invest a large sum today and you're waiting multiple years in the future to make a return, $20,000 10 years from now is not the same as $20,000 today. You know, $40,000 today may buy you a 4-year college education at a public school, but in 20 years you may need $400,000. So it's a concept we've talked about before. So we're going to discount the future cash flows and then add them together and compare it to the initial cost of the project. Okay, so it maintains all the benefits of calculating a project, their future cash flows, but adds the benefit of reflecting time value of money in the project. So we're going to use a discounting cash flow model. And here's the model up here already, and you can see that this is very similar to the present value formulas that we learned from Chapter 8. So what we're doing is cash flow 1, cash flow 2, all the way to the ending cash flow. We're going to discount each cash flow separately, add them together, and then subtract the initial investment from our cash flows. And if we have a positive number, we know that this project is making us money. That's better. So let's go back and look at project B, and we could calculate the present value of project B. So here again we have the discount. K is the discount rate of 10%, and we're going to apply that to the future cash flows. And for year 1, year 2, and just like in time value money, the exponent is the year at which we're going to make the money, and that's going to be our discounting rate. So, okay, so you can see here that for each year, up until last year, and you can see here for $10,000 gets discounted to $6,800 in year 4. It's a huge discount. And this discount rate comes from the weighted average cost of capital that we use in Chapter 9 to calculate the cost of capital for a company. That will become our discount rate, because that's what we're paying to borrow the money for the project. Okay, so if we add up all of the if we add up all of, I don't know why this keeps getting lower. We add up all of the cash, we get 11,150. And then if we subtract, that's greater than 10,000 in costs, and we have a net present value of $1,154. So greater than the costs, and this would be an acceptable project. Now, maybe $1,154 doesn't seem that worth it, but what if this project was really truncated and this is in the billions? So by taking on this project, we would make $1.1 billion to make it seem a little bit more appropriate for a larger company to get involved in it. Okay. So if the project is greater than the net present value, if the net present value is greater than 0, we want to accept it. If it's less than 0, we want to reject it. So project A is greater than 0, we'd accept. And if we look at project B, that's also greater than 0. So if they're both independent, we could accept both projects. Maybe they're two different stores. But if it's mutually exclusive, we can only pick one of the two projects. And we would, of course, accept the project with the highest net present value because we'd have the most return. All right. Okay. Oh, let's take a... So internal rate of return is a similar method, but here we're not measuring total dollars, we're measuring percentage. So we want to... we're looking for the discount rate or the rate of K that will force the net present value to 0. So if we can bring net present value to 0, the rate or the percentage equal that K is equal to will be the return on the project. So if it's greater than 0, you're returning more money than you're paying for the capital to put into the project. The internal rate of return assumes that the cash flows are reinvested at the same rate at which you borrowed the capital at, or the same rate you've earned for the cash flows. I think it works out better that way. So that's actually a flaw because the rate of return, they're never equal, but the internal rate of return assumes that they're going to be equal. And that's sort of what the modified internal rate of return will take care of. But so the net present value, project A, we want to set it equal to 0. And to get it equal to 0, we would put, this is really present value of annuity formula. We would solve for K inside of the present value of annuity formula. And in this particular response, K is equal to 14.96%. I will show you how to do this by hand and or spreadsheet because solving for K, your algebraic skills must be pretty advanced to reformulate this problem to solve for K. I'm not saying you couldn't do it, but I'll show you an easier way. All right. In project B, since project B is not a uniform, consistent cash flow, we're going to have to break it out by year. And this is by and large how we're going to calculate it by hand too. And so for every year, 0, we have to find a rate of K that we can discount each of the years of capital minus the 10,000 equals 0. And for project B, it would be 13.5%. So for internal rate of return, it would say to take project A because it has a higher percentage return than project B. So of course, whoever has the greater required rate of return, a greater return above the required rate of return is the project we'd want to take. And we want to reject any projects where the internal rate of return is less than the required rate of return that we need for the project. Just like we don't borrow money against our cash advance on a credit card at 22% to put in a bank account that earns 1%. So so project A we would accept, and project B we would accept, and if they were mutually exclusive, we would go with project A that has a higher return. Okay. Okay, so the modified internal rate of return solves the problem of reinvesting at that same rate and lets us reinvest at a rate which equals the actual rate of the project. All right. So this would be the basic formula, and the formula is not really easy to work with. I'm going to show you how to do this on paper in a spreadsheet, and we're going to assume that cash flows are reinvested at K, the cost of capital, not at the rate of the project. I'm sorry, the internal rate of return assumes everything's reinvested at the rate of capital. But that's not true. Some projects will return a rate higher than the cost of capital. So why are we, if we reinvest the project, we want to invest it at a rate that's more accurate to the project's actual return. All right. So if we had, this particular project, we actually kind of work backwards. If you see the discount here, instead of this being year 1 and exponent 1, it's now year 1 exponent 3, because we take basically the last year and subtract it from the year we're working with. So year 2, 4 subtract year 2, exponent 2, 4 subtract year 3, exponent 1, 4 subtract 4, exponent 0. So here we're going to actually sort of we're going to escalate, sort of find a future value if we're reinvesting at this rate of 10%, add them together, and then going to divide by 1 plus the modified rate of return to the power equal to the number of years of cash flow we're working on, so 4% and 4%, to give us the modified rate of return. So again, this is just really looking at the same problem a little differently to make it a little bit more realistic. And when we go over the handouts, I'll explain it again. It would be a great help if you would read the chapter before the next class, before I go over the handouts and we actually do this in class, so you have a little bit better mindset. So when I explain it, after you have a basis of understanding it, it'll be a little clearer. The net present value, internal rate of return, project A, and then if we look at, this is where we have a conflict. So in project A, the A has a higher internal rate of return, but project B has a higher net present value. So which do you choose if the two different methods are not making a clear choice for you? Basically, it depends on which approach you want to take. Academics usually prefer net present value because it's giving you a dollar amount, and the larger the dollar amount, the better. Returns, total returns for the company. But many executives like the internal rate of return because they like the percentages. So they see or hear a higher percentage, that's the project they want to go with. So if you're asking an academic like me, I would say you go with the net present value. If you're asking an executive in a business, he may favor internal rate of return and select that. But I guess the real truth is, if there was a conflict like this, you'd really want to examine the two different projects. Which has a better future potential? Which is less risky? There's other factors that can go into it. Which is, which has a chance for the current management of the company to run more successfully? So other real life factors will come into play. And I guess also, if both projects are independent, you would accept both of them. So if they both make money, they both beat your cost of capital, then accept both of them if you have the capital budget for it. So if they're mutually exclusive, we would call that a ranking conflict. We have a ranking conflict between these two methods, and then the management would have to do further analysis to decide which would be appropriate. Okay. And you can make sort of this net present value graph where you could plot the change in the project's net present value as you have a change in the different interest rates. So as the cost of capital increases, the value of the cash flows go down because you're discounting them more heavily. So you can understand that if companies have to pay a lot more money for additional new capital, it will make for future projects look less desirable. The same reason that if you're going to borrow money, and the more money you borrow, just like in a Zoom simulation, the more money you borrow, the higher your interest rate goes, the less affordable, the less desirable it is to borrow that money, because if the cost of money starts to exceed the return of investing that money in making more cars, it's just not worth it. The main reason you don't take a cash advance on your credit card, because they charge you like some ridiculous amount of interest and fees to take an advance of cash on your credit card. And you learn that the hard way usually the first time you take the cash advance, and you see, oh, it has its own separate interest rate, there may be additional fees and charges. It's just never worth it, unless it's an emergency, like you're at a casino and you're down 500 and you just need a little extra money to fund you to get you back to zero. Then you may take that. I'm kidding. You would never do that in a casino. Hopefully not. Okay. So risk is a huge part of these different projects, and we'd have to really consider the risks of the projects. And one way to embed the risk into these analysis is to change the discount rate for the riskier projects. So if the cost of capital is 10%, and you're looking at 5 different projects, and 2 of them are very risky, you may make the discount rate, say, 15% instead of 10% to reflect the additional risks or likelihood that the cash flow won't develop. So you can embed the risk into the discount rate for the riskier projects. And that way you can kind of even the playing field of the returns. And hopefully if a riskier project isn't going to return more cash flow, then the higher rate will just make that more obvious. But there are some projects that are riskier but worth the risk. So even though you put a higher discount rate on it, it's going to return so much more extra money that it will be, this capital budget will show that it would still be a project to consider. When we talk about a hurdle rate, when we evaluate the internal rate of return, we can come up with a percentage as a hurdle rate, saying that all projects must exceed 15%. That's our hurdle rate. If they don't exceed the 15%, we're not interested. Okay, so we can, going back to this chart. Okay. If we look at these, should be both projects, A and B, graphed. Now remember, the projects had one of the projects had more money sooner, and one project had a lot more money later. And you could see that as there's a crossover point between project A and B, based on the different distribution of the cash flows through time. So at one point, project A seems like it has a higher net present value because the discount rate is lower and the project cash flows come later in the project, the $10,000 in year 4. But as the interest rate or the cost of capital goes up, project A becomes more desirable because you're getting more cash sooner than project B, so less discounting is involved. So the point at which the two projects cross over is called the crossover point. And that is so there would be a ranking conflict at that point because they're getting two different results. Okay, so if we talk about the concept of capital rationing, what we're talking about is you only have so much money that your company can employ. Sort of like year 1 of the Zoom simulation, you went in and said, okay, give me 10 levels of all of the operational investments. And then you figured out when you get to the finance page, it says, you know, we can't process because you have a bigger than $25 million debt. So you go and borrow as much long-term and short-term, issue as much stock as you can, but there's a limit. It stops you and says you can't borrow more than X amount this year. So then you realize, okay, there's only so much capital I can generate in year 1. I'm not going to be able to build 6 factories for each car and buy all the operational investments. And you have to actually start rationing and saying, okay, what should I do? Well, I can, buy 1 level or maybe 2 levels on this car, 1 level on that car, and you start making decisions based on what you feel will be the biggest payback. For example, in the beginning of the simulation, it may pay to get more levels of cost reduction on the vehicles you sell the most of, economy and sedan, and then later on, when you start making more money or the amount of cars you're selling increases, you could start aggressively buying the cost reductions for truck and luxury. Okay. And this basically helps you choose between combinations of projects that yield the highest net present value without exceeding the budget limit. So you may have a certain amount of money, and after your main projects go through, you only have $20 million left. So if you could find a project that will be that size and still make money on, you could fit it into your capital budget and get 4 projects rather than just 3. But generally, I'm going to show you a chart in a minute. What's this thing? Where is... I'm going to come back to this. Maybe I don't have the chart in here. Oh, I don't. Okay. Yeah, I thought there was a capital rationing chart I had in here. I must have took it out for some reason when I was editing the... Sort of a quick review for the test. Yeah, there should be a chart here. I guess I skipped it, but basically you would line up, you would draw a line of how much capital you have, and then you'd lay the projects until you fill up your capital pool. And then, as we learned in cost of capital, there may be the next level of funding will come at a higher rate of interest. So then you would have to find projects that would even be higher to fit into that budget. All right. If we're talking about risk, all the capital budgeting projects you should have an idea of the risks involved of the projects you're going to start. And there's a process that we look at. Find the CV stands for coefficient of variation of the existing portfolio, and that's basically the standard deviation divided by the mean or expected value. Now these concepts in this chapter I'm not going to I don't think there's going to be any homework on this, and I'm pretty sure it's not going to be on the exam, but I'll double check that. Because basically what we're doing is a standard deviation formula on the project to get an idea of the dispersion of returns. These are all like statistical measures. So we would plot the likelihood of the risks to get an idea of the range of possible return. And then we'd calculate a standard deviation to give us that percentage range. And since different projects come at different sizes and different risks, we could use the coefficient of variation to normalize them so we could kind of compare the risks to each other. All right. And this is basically, if we could do it by portfolio too. So if we had a portfolio of investments, we could get the expected return, sort of a weighted average return for that portfolio, and then we can compare that to the coefficient of variation for the portfolio. And the higher this percentage, the riskier that portfolio is. So we would basically, if we're a large company, we'd compose various portfolios until we'd find the optimal portfolio with the lowest amount of risk and the highest return, sort of an efficiency frontier of portfolios. And we could compare the different coefficient of variations, which is just a factor of risk between the different makeup of the different portfolios to say, okay, of all the different, mixing up all the different businesses and projects together, this portfolio has the highest amount of return with the lowest risk. So let's go with that set of projects, is basically what we're saying here. Here are three separate projects, coefficient of variation without project Y, and then the coefficient of variation with project Y. And we can see that since the percentage is higher with Y, we'd want to go with the group of projects without Y, because it gives us a lower coefficient of variation and a lower risk. If you are an AMS minor, you follow that pretty closely. If you are a business major, you may have to read a chapter. But don't worry, I'm not going to, I don't believe I'm going to present any problems or questions on this from the chapter. We're going to focus mostly on the capital budgeting aspects. All right, so let me switch over to Excel. This is the wonderful Windows 8. Microsoft's campaign slogan was almost 8 is great. But then they realized the shampoo company did that, so I don't know. There was a company that had that slogan. 8 is great. Okay. Say we have a series of cash flows, and we're going to be doing, I have handouts on handouts, too late to hand them out, but we're going to be doing these in class by hand. But say you have a business, and you want to open up your own TV station, and that may take an investment of $50 million. And you're hoping that each year this TV studio is going to return to you $5 million in profits. Let me make this bigger. So if you want to know going out a certain amount of years, and you expect to run this 1, 2, 3. Actually, let me put the numbers up here. And you're going to run this business. Come on, work with me, Excel. For 8 years, and you want to know the net present value, you can easily insert a formula. You could search in Excel for there, and this is one way if you're doing the homework, you can use Excel to quickly calculate. I'm going to say a discount rate of 10%. And we'll select all the values. And we see that is actually a negative net present value. Okay. Maybe I made one reason for this is maybe I made this number too big. Nope. Okay, so that has a negative net present value. So probably would be a losing money proposition in the beginning. But what if we actually were able to lower the discount rate from 10 to 5%? So I'm going to just change this to 5%. And we find that the net present value now is not negative 21 million, it's only negative 16 million because you're paying less interest on the investment. So then you rework your plans and you figured out that you could, you're not making 5 million a year, but you're really making 8.5 million a year. So you figured out a new model, maybe some profit sharing with a website or some such thing. And then at that level, the project becomes profitable, net present value of 4.7 million. And the internal rate of return is just as easy. You go to the insert function and you search for internal rate of return. And you click on internal rate of return and then put in the values of, and it'll do all the discounting and formulas for you. And we're going to say, you don't have to guess. What's that? I thought you wanted me to guess. But it comes out to be a return of 7.39%. So if your rate of interest is 5%, the 7% net present value is higher than 5%. So that would be an acceptable project. So this we're going to learn how to do by hand in class for the most part. But for the homework or for any projects, Excel makes it a very quick and easy way to calculate net present value or internal rate of return. Okay. And the payback period, if we were to do the payback period, we would want to take, if we were going to count the years, we would say, you know, and we would add that to the cash flow for that year. So we would do this until the cash flow actually became positive. Okay, so in year 6 it becomes positive. So we would say that 1, 2, 3, 4, 5 years, 5 full years, and then a fraction of the last year. And for the last year, I would take the 7.5 million, and I would divide that by the 8.5 million to get a fraction. How long of the year did it take me to actually earn that? Okay. So if I'm going to earn 8.5 million in year 6 and I owe 7.5 million, it's going to take me 88% of that year until I actually pay myself back. So the answer to the payback period would be 5.88 years. So those would be the three. How on Excel you can easily calculate the payback period, net present value, and internal rate of return. Okay.